Welcome back, IBC guys. I'm Dave. This is
Mike?
and we got a good episode for you today. So today we are going to talk about really a commonly asked question. So whole life compared to term. So the commonly asked question is, why wouldn't I just buy term insurance and invest the rest? Someone very close and personal to me, my dad, asked me that question. So there's a great answer for it, and that's our goal today is to answer the commonly asked question of why would I buy whole life instead of just doing term? So within that, we always want to give an application, and I'll refer back to this at the end of the episode as well. The application is to start comparing and contrasting a whole life insurance policy within the context of infinite banking. So if you forget that infinite banking component, it brings a different connotation in. So with infinite banking, but to compare whole life with the infinite banking context compared to term insurance. What are the benefits? What are the downsides of both? Start doing your own research. And then the second thing for application, again, I'll say this at the end, give us a shout. We want to talk with you. Our goal is to educate people, to provide understanding, to have you better comprehend what's going on, and then make a decision moving forward from there. So if you find this beneficial, like, subscribe, do all the things. I'm sure I always forget something, but help us out. Our goal is to get this information out to people the best way we can. All right, all that's out of the way. Mike Stevens, term insurance, whole life insurance.
Yeah, so I think one of the biggest what's a misunderstanding. I think for the most part, people don't understand what whole life is, and I don't know that whole life really is insurance, or shouldn't be called insurance. Isn't insurance in the way we understand insurance?
Now
So
that's an interesting
for
statement. You're gonna
example,
have to
okay,
explain that
yeah,
one.
for example, so this is, I think, what we as Americans we think as insurance. So you get insurance on your house. We're in my house right now. I
Mhm.
have insurance on this house in case it burns down,
Mhm.
right? And the term is the length of whether it's a 30-year term mortgage, that's the
Mhm.
length of your loan. The term is the length of the insurance. So most everyone, I think, has 1 year term insurance on their home,
Yep,
on their house.
that's what ours is.
Yep. I think everybody is you pay an annual premium, and if your house doesn't burn down, the insurance company keeps 100% of that money.
Yep.
Same thing on your car, annual, sometimes it's maybe every 6 months,
Yeah.
but you pay an insurance premium
Mhm.
on a term, 6 months or a year. If you don't crash your car or hit a deer or whatever, insurance company keeps 100% of that money.
Yep.
Same thing with health insurance,
Mhm.
and that's what I think most Americans identify as insurance. You're
Mhm.
basically transferring that risk
Correct.
for an amount of money that you're never going to see again.
You're limiting risk is really
Really, you
what it
don't
is.
see
Yeah.
again because you don't want to have to claim
Yeah.
on that, especially if your house burns down.
Mhm.
So
Yeah. I mean, something
I think
happened.
that's how we understand what insurance. Whole life really isn't insurance. It's a contract
Mhm.
that it's kind of a guaranteed wealth contract. Like, I want to have $1 million, or I want to leave $1 million to my kids when I die. And the insurance company is going to say, okay, to do that, you got to put X amount in
Mhm.
every year as a premium,
Mhm.
and build up to that.
Mhm.
And when you die, we will guarantee you by law, by contract, we're going to pay that $1 million tax free to your beneficiary. The nice thing about that is why it's guaranteed. Let's say, for example, we want to do that just in a savings account. I want to save so much a year based on whatever interest rate you're going to put in there. That I want to work for so many years and save for so many years. I want to have $1 million. There's lots of apps out there that you can go on and
Yeah.
say, I want to have $1 million in 30 years and this interest rate. They're going to tell you what you have to put in there every year.
Mhm.
Well, if you die in that first year, your wealth plan of that $1 million you wanted to leave to your kids I mean,
Out the
it's
window.
out the window.
Yeah.
If you put in $10,000 that first year, that's all they're gonna get,
Yep.
because you died. You failed to execute the plan. Whereas a whole life or permanent policy, this contract, it guarantees that. You put X amount in for all of these years, we guarantee you that at any time during that term, which the term is life,
Yeah. Term is the wrong word. Yeah. Life.
yeah, that we're gonna pay that $1 million. So really, it's really not insurance as we know it. It's a guaranteed wealth plan
Well,
backed up by a
let
contract.
me ask you these two things. When you say contract, contract is one party signs an agreement to what this states. The second party agrees to what states in the written contract, correct?
Correct.
Both parties agree. Who can
Correct.
break that contract?
Well, the contract that the insurance company, it's if you do this, we're going to do this.
Correct.
And it's with a privately held insurance company.
So so you already hit on my question. I want to
Okay.
make sure it's clear. My question was, can the insurance company break that contract?
No, not by law. It's
Not
required
by law. Correct. So if you sign like, on the dotted line and they sign on the dotted line for $1 million death benefit, and I die the next day, what does that contract say?
They're paying your beneficiary $1 million
$1 million.
tax-free.
They cannot break that contract regardless of time. If you pass away, they are obligated to pay that $1 million. So I wanted to kind of hammer home the contract idea versus term. Well, let's say you paid for a year. Well, you're a year and a day out. You didn't re-sign. You're up a creek without a paddle at that point. This is not that. Once that contract is signed, it is life. It is permanent, to use both of those words. You die the next day, that death benefit is in your beneficiary's name, guaranteed contractually. So I just wanted to make sure that was clear.
Yep. And return. So here's the problem with so the whole life is it's a contract that is guaranteed by law. If let's say something should happen to the insurance company, which never happens.
Yeah.
Insurance companies just don't go out of business because they just never, ever, ever lose money. They pay a dividend every year for 130 plus years. They just never lose money. But let's say they were to go under for whatever reason. There is the insurance business is backed up at the state level. So there's like a state, like a FDIC fund type thing that by law, whatever state you reside in, they have to honor the contract of that insurance company, even if the insurance company were to go under or insolvent. So it's about as a guaranteed of a contract as you can get. So which is nice when you have a wealth plan, like this is what I want to do for my family and my family legacy. It's guaranteed by law, by the state. It's pretty solid. On the other hand, the term insurance, again, depending on, and what we talked about examples of homes and cars and health insurance, that's generally 1 year. Term insurance can be 10 years, 20 years, even up to 30 years. It's a longer period of time, but insurance companies pay out less than 1% of term insurance policies. Do you know why that is?
Do I know why it is? Enlighten me.
The reason why that is because if you were to get $1 million term insurance, you're young, that may cost you, let's say, $1,000 a year.
Okay.
The closer you get to death, actuarially, let's say you're going to die at 87. The closer you get to 87, the more expensive it is.
Yeah.
So especially when you hit 65. So the reason why the insurance companies pay out less than 1% of these term life insurance contracts is because as you get closer and closer to, let's say, 87, it becomes cost prohibitive for you to
too expensive to get term.
It's too expensive. Yeah. So it may cost you $1,000 now. When you hit 60, 65, it may cost you $13,000. When you hit, say in your 70s, you're getting closer to death. It's a high risk for the insurance company. You get closer to death, it may cost you $25,000. And I give the example of if you're if you're 95 years old, if you were an insurance company and someone stumbled in your office and they're 95 and they come in on a cane and they say, I want $1 million that if I die within this next year, I want a 1-year term.
Yeah.
How much is it going to cost me?
Million bucks.
But if I die, you have to pay my wife $1 million. I mean, the
999,000.
chances of that
Yeah.
person dying is probably 50-50.
Yeah.
Right. So, I mean, it's going to be $500,000 term. I mean, expensive. So in this example, when you're 70, that's why $1 million term is more of, I mean, that could be, $30,000-$40,000. So
Yeah.
it gets cost prohibitive for people to, as they get, I mean, when the need is there, I want it when I'm going to die, you can't afford it. So as an example, so let's say for $1 million of term insurance for you, let's say it costs $500 a year. Okay. Term insurance. If you don't die in that next year, you lose, I mean, the $500 leaves your family, it goes to the insurance company.
Yep.
Okay. So let's say you got a 10-year term and you're
Okay.
going to pay $500 a year for 10 years. And hopefully you don't die in 10 years. You don't plan on dying in the next 10 years, right?
Yeah, fingers crossed.
So,
plan on
so after 10 years,
okay.
you will have paid $5,000
Mm-hmm.
total, $500 a year. You have zero cash value.
Don't see any of the money. Yep.
And after that, if you don't renew that, which is going to be more expensive when you renew it, you have no wealth plan. Your family's getting zero unless you get additional insurance. But it costs you $5,000. Okay. Now compare that to whole life. That same $1 million death benefit or guaranteed wealth plan,
I like it.
is, let's say it's $10,000 a year, not 500. Let's say it's 20 times more expensive.
Yeah, significantly bigger number.
Yeah, and people say, well, it's way more expensive than term. However, if you put in 20,000 a year,
okay,
or what did I say? 10,000.
You said 10.
10,000.
Yeah.
10,000 a year. 20 times the 500.
Yeah.
If you put in 10,000 a year for 10 years, that's 100,000. Well, whole life also has cash value, so you're building cash value in there.
Yep. Can you explain real quick what that is? What do you mean build cash value?
Well, when it's like a guaranteed wealth plan. It's like a guaranteed savings plan. So when you're putting premium into that plan, it's building cash value.
You're making money on your money.
You're making money.
Yep.
So that cash value is growing towards that amount that you wanted to leave, whatever the death benefit is that you wanted to leave.
And one more thing, how is it growing? It's growing exponentially.
It's growing exponentially.
So that's another episode. But you're putting money in, it's making money, and it's making it exponentially. So I got you sidetracked. I apologize.
10,000 a year.
Yep.
For 10 years, you have $100,000 that you put in there.
Yep.
But let's say you have $105,000 cash value.
Mm-hmm.
So how much did that whole life insurance policy cost you after 10 years?
Well, explain what. Yeah. So you're asking me as a rhetorical?
Yeah. Well,
5,000.
If you put in 100,000 a year, 10,000 a year for 10 years, you put in 100,000, but you got 105,000.
Yep.
You didn't cost you anything. Like I actually made a little bit of money.
Yep.
I mean, the return's not fantastic on that, but you made money.
I think
the cost of it is zero.
Well, and where my mind went to is what can be done with cash value, and that may be another discussion for another time.
Right, but I'm looking at just the cost of.
So it costs me nothing.
It really costs you nothing, but back on the term, even though it's 20 times less, it's only 500 a month a year. We're gonna have to redo this thing. We're gonna have to 500 a year for 10 years. That's $5,000.
Yep.
Well, the guy that does the term is out $5,000.
Yep.
The guy that did the whole life, even though he put in more money, he's actually $5,000 ahead.
Correct.
So my argument for people to say that term is way more expensive, or the whole life is way more expensive than the term. My question is it really?
Yeah.
Because I don't think it is. I think it's cheaper. One costs you $5,000, the other one makes you $5,000 and guaranteed for life.
Yeah, that's where my mind's going.
It's a contract. It's really not more expensive.
So one thing, let me jump back. So whole life, you talked about term getting cost prohibitive as you get older. So you call me young, I'm not that young. But let's say I'm not 79 years old. We'll put it that way. We'll let people guess how old I am. I'm not 79. So to lock me in at a younger age and have that contract be in force until I die, talk about being not cost prohibitive. I mean, start young and that contract is guaranteed until I die. So would it cost me more if I were to come get a whole life policy at 79? It would. I mean, I'm gonna die sooner than I would be if I got it now. But to get in young, you're locked in at that rate, paying those premiums rather than after 10
Correct.
years, you're reassessed, for lack of a better word, for your health, for your condition, all that. And that premium payment goes up. So with whole life, I think that's another added component to it. You're locked in when you get that at the age you do it. Your premiums don't go up. So that's another
Correct.
thing
Yeah,
to be
they
said.
never increase. So to explain that a little bit differently, if you were to get a 10-year term policy
Mhm.
today for 1,000,000, and let's say that cost you $500 a year,
Yep.
and you did that for 10 years,
Yep.
you didn't die,
Didn't die.
thank goodness.
Yep.
Now you lost you $5,000 left your family,
Yep.
but you're still alive. Awesome. But I want to do another. I want to leave $1,000,000 to my
Yep.
kids. So let's do another. I'm going to go another 10-year policy. That 10-year policy is not going to cost you
I'm
500 a year.
10
It may
years
cost
older.
you 1,200 a year.
Correct.
In the next 10 years, it may go up to 8,000 a year. It just goes up exponentially
Correct.
as you get older. So that's one component of it. Whereas the whole life, as you mentioned, doesn't do that. The other thing that's very important is when you get, be it a term policy
Mhm.
or a whole life policy with an insurance company, they're going to do their due diligence and check out your health.
Yep.
They're going to look at your medical history and did you just go into the doctor and find out you had 8 types of cancer and no, that's why you're coming to get a policy
Yeah.
because I think I'm going to die here in the
Yep.
next 10 years.
Sure.
They're going to vet you out. They're not going to give you a policy if you
Yep.
have, type 1 diabetes, things like that. So my point being is if you go in today and get a 10-year term policy and 10 years down the road, you're still alive, to get that next policy for 10 years, you got to go through your health check
Yeah,
again.
reassessed. Yep.
If you got a whole life policy, that contract is for life
Yep.
and they're never going to recheck your health again. So if you let's say you got a term policy, I'll use myself as this. I got a term policy today, 10 years, and we're being told the battery's running low.
Keep rolling, pushing through.
Professional audio crew here, our video or that whatever.
Podcasters.
Podcasters. I was just saying our laptop just said our batteries are low. We just plugged this thing in. How's our battery running low?
We're good. We're almost done.
Okay, so let's say I got a 10-year term policy, and 5 years into that, I got diagnosed that I have cancer.
Yeah.
Okay. It expires 5 years later.
Mhm.
I didn't die yet. I'm fighting the cancer.
Yep.
But I want to get another policy because I want to leave $1,000,000 to my kids.
Yep.
I'm never getting a
They're
policy.
not gonna give you one.
Like, no, they're going to reevaluate my health and say, well, we found out you had cancer and you've gone through chemo and blah, blah, blah. I'm never going to get a policy again. I mean, never. However, if I got a whole life policy,
Mhm.
not 500 a year, but I'm paying 10,000 a year, and 5 years in, I get diagnosed with cancer.
Yep.
That contract is good for life,
Yep.
regardless of what happens to me after the fact.
Yep.
That is locked in for life.
Yeah.
As long as I cleared the physical, the health check when I
The
issued it.
contract.
So,
Yeah.
yeah,
Everybody
it's
signed.
it's a lifetime contract. So big differences on the term versus whole life and big differences in controversy, I guess, on which one is really more expensive. The premiums are obviously more on the whole life, but 10 years down the road, is it really more expensive?
Well, and I think the question is,
I would argue.
does premium determine how expensive something is? I think that's a question to be asked.
Correct.
Right?
That's a good question.
So we'll get into that a little bit more. We got a bunch of other episodes that we're going to talk through this. But for sake of time, for the sake of our battery running low, we're going to end here. Application. Go out and do some research. What are the benefits of term? What are the downsides of term? Benefits of whole life? Again, within the context of IBC, I would ask you to do that. That adds a big connotation to it. What are some downsides? There are some. There's not a lot, but there are some. Doing your own research. And then the other thing, give us a call. shoot us an email. We'd be happy to talk. This is what we do. We love talking about this. We love helping people. Give us the opportunity to help you out if you would be so kind as to do so. All right, that's it. On to the next one, right?
Sounds good.
Ah, yeah.